Time now for a conversation with a veteran U.S. equity strategist. Let's welcome Drew Pettit to the program, U.S. equity strategist at Citi Research. Drew, thanks a lot for joining us. I've read through some of your notes, and you have been constructive on U.S. stocks as 2025 approaches ever closer. Did yesterday's news from the Fed at all change your outlook?
It didn't actually, and honestly, volatility is something we expected. When we look ahead to 2025, and honestly, what might have been pulled forward into yesterday afternoon, is we expect this bull market to enter a more volatile phase. We thought a lot of policy uncertainty in the first quarter, the Q4 reporting period in January would really spark volatility. But the Fed yesterday kind of talking down the path of interest rate cuts and maybe the stickiness of inflation really hit markets in the afternoon. But overall, the economy still looks solid. Earnings growth looks good. We're still constructive on U.S. equities. Your
base case target on the S&P 500 is 6,500 points. That is that would be a double-digit return from where we are today. What kind of earnings growth are you assuming gets the S&P 500 to 6,500 points?
Yeah, we're looking at about 12% in our base case to get there. So that basically means we have to hold multiples at the high levels where they're at. Honestly, when we put the target out initially, we were more like mid-single digits upside for next year. And when we look at a lot of our peers, that 6,500 number is actually closer to the low end. So how we're thinking about the narrative is we get that first half volatility that presents some buying opportunities into some second half tailwinds.
You do say in your notes that at this point, that's you and your colleagues at Citi, and I guess everybody else, do not have sufficient Trump policy information to build into our fundamental framework with any confidence. So help us explain why your base case forecast is a 12% rally in the S&P 500 without sufficient information on U.S. policy.
So tariffs have been talked a lot about. I've been on your show before talking about this, and honestly, we're kind of working off tweets at this point, so hard to really factor into a base case. But what we learned in Trump 1.0 was there were a lot of exemptions granted, about 93%. So tariff impact, we may not see that directly translate to the S&P 500. Then pair that with tax cuts, which probably aren't a 2025 thing. That might be in 2026. So this really leaves the structural drivers in place for the S&P 500 earnings to move higher. And that's productivity gains broadly, and then secular tailwinds like AI that are driving some of the big stocks and their earnings growth higher.
You are not assuming a significant run-up in inflation driven by U.S. tariff barriers, correct?
Not right now, but I will say the pass-through, like say we did get broad 10% tariffs and even 25% on Canada and Mexico, which, again, not our base case, not fully baked into numbers. There's probably some margin squeezes back in the value chain, some you get on the S&P 500. But ultimately, when you think of a lot of the service-heavy names, they're not impacted by tariffs. In international trade, you don't tariff services, you tariff goods. And that's not really what is heavily represented in the S&P 500.
Some of the themes you like in 2025, themes that you think will be drivers of gains, artificial intelligence, you don't think that's going anywhere. Digital leisure is one of your themes, and financial technology as well. Talk to us about those related themes.
So AI, we all see the tailwinds there. There's a lot of building of the infrastructure, but we do see some big names like Meta, for example, actually monetizing this through better ad spend and ad revenue. Amazon, to some extent, kind of plays both ends of this with advertising and AWS. Digital leisure is an interesting one because that's been very disruptive to, typical cable networks, but that extends beyond just streaming services. It could even be online gambling, honestly, books, podcasts, and so on. And the ad platforms around those get interesting as well. And then fintech, honestly, if I told you that was the best performing theme over the past 2 years, the past year, and post-election, you might not believe it. But there's a lot of these names in the payments ecosystem that actually benefit from deregulation. And I think a really interesting stock that kind of explains that theme in a nutshell is something like PayPal. So I do think there are a lot of structural trends in place beyond just AI. And I do think some of them are probably underappreciated right now.
What sectors of the U.S. stock market do you think investors should either avoid or reduce exposure to?
We get a little bit concerned around defensives. Now, that could be anywhere from consumer staples to healthcare, for example. Those two kind of top our list of underweights. You know, they're very rate sensitive, especially on the staples side. And, you know, with the Fed commentary yesterday, that kind of confirmed to us that rates may have some volatility ahead. We're not necessarily on this really smooth trajectory down in rates. So we want to be a little bit cautious when we're getting into rate sensitive areas of the market.
Drew, thank you very much, as always, for a good conversation. Drew Pettit, U.S. equity strategist at